Vipul Prasad of Magadh Capital is joining us. He's a mid-cap, small-cap specialist. In fact, he's got a kind of a flexi-cap approach to his PMS fund. He's got a bit of large-cap, mid-cap and small-cap, a balanced kind of a approach to the market. Vipul, afternoon. Thank you so much for your time. Before I talk about your bullish, bearish areas, I wanted to understand the setup in your mind about markets. This divide between valuations and earnings growth, macro setup, ownership, flows. What are your thoughts on the market?
Good afternoon, Ajay. Always a pleasure to be on your show. Thanks for inviting me. On the markets, we remain constructive from a 1 to 2 years perspective. Shorter term, obviously, is very difficult to take a call, and also it's futile to take a shorter term call. The one thing that we've been facing a lot of questions in the recent past is that what to do in the markets. Last 9 months, the trading performance has been phenomenal. There's no doubt about that. 2023 was quite good. So does it mean that it's time now for withdrawal of cash? To us, there are two elements here. One, we also have to look at what has been the performance over the last 2 years, 3 years, 5 years. So if you look at those time periods, if you go longer into the past, then we see the performance CAGR has been more like 12% per annum over 2 years, maybe around 16% per annum over 3 years, 15% per annum over 5 years. So these are not very different from what has been the last 10-year or 20-year average. So the last 9 months performance should be seen more as a sort of catch-up rally after 3-4 years of subpar performance. So first thing is that just the performance should not scare us, the 9 months performance. Secondly, after this performance, how are the valuations looking like? So if you look at the multiples, let's say price to earnings or even price to book, we are where the last 10 years averages are on both price to earnings as well as price to book. So it's not stretched at all for Nifty 50. So that's the point here. And that's why we are saying that there's no point in trying to act smart and trying to outguess the market. Just stay invested. And this is what we are doing. We are fully invested. And having said that, does it mean that everything is hunky-dory? Obviously, no, we don't think so. Because the first point is that small caps and mid caps, they have done amazingly well. And after that, the valuations do look a bit stretched. Not a bit, actually, they do look stretched, especially for small caps at the index level. So that is one caveat that one should have in mind while investing in these markets. And the second thing is broader in nature, that when we are investing in equities, we should always be prepared for a 10 to 15% correction. At any point in time, for no rhyme or reason, it happens, right? So that can happen anytime, and we should not be scared of that. One has to take that into stride. So that's the way we are looking at it. From a longer-term perspective, we are very constructive in the markets. So we are looking at the kind of things that are happening right now in India. 3 things that we are very, very positive on. First, rising disposable incomes. Second, the infrastructure build-up that we are seeing right now has been unprecedented. And this is something where this is somewhere where we are building a sort of foundation for longer-term expansion in broader economy as well as corporate earnings. And the third part is the set of reforms that the government is undertaking. So all these 3 things make us quite constructive on the markets from a longer-term perspective.
Vipul, what are your most highest conviction bets right now, which you are comfortable holding in the next 3 to 5 year period?
So I'll talk about the sectors per se. We are very positive on banks, sort of large lenders I'm talking about. And this is a mix of PSU banks as well as private sector banks. So for us, the story here is very clear that the credit growth is picking up. The NIMs are stabilizing, and the asset quality is further improving, which means that at the bottom line level, the benefits from reducing provisioning will continue to play out for another 4-6 quarters. So we are looking at a scenario wherein the NPAs are still coming down, and the earnings growth is quite healthy. So given this, I would have assumed that the valuation should have been higher, which they are not. which means there is a lot of money on the table here. So that's why this broad set looks very interesting to me. And one more thing here has to be kept in mind when I'm talking about the credit growth. So far, private capex has not yet come into play. So, and I would say as the capacity utilization moves up from say around 75, later into the late 70s and crosses the 80% mark, we'll see a spate of expansion activities starting in private sector, and that is when the corporate capex begins. So that's why, all in all, banks are looking very interesting to us. Secondly, infrastructure engineering sort of, and this to me includes defense and railways also. So basically, the entire ecosystem around the manufacturing activities in the country, especially given the fact that the way government is pushing it full throttle. So we would be we are quite positive on this space also. Lots of stocks in our portfolio also happen to come from these sectors. Of course, some trimming from our perspective has happened in case of defense sector. To some extent, in some companies we saw some overheating. So we have got, but still in defense also we are strongly overweight. But apart from that, engineering and infrastructure are also looking very good to us. And the third one that we are where we are quite positive on is consumer-related sectors, so discretionary as well as staples. So there are many stocks in both.
Can I just interrupt you here? Let's break down these ideas into smaller pieces. Infra and engineering, how are you playing this in your portfolio?
So see, for example, again, the normal disclosures that we are invested in these stocks, obviously, and these are not any advice for purchase or sale. So for example, L&T is one stock that we like quite a lot. If you just go by historical valuations, then it may look slightly stretched, but the kind of order book that they are accruing and the kind of capability expansion that they are doing in terms of execution capabilities, and also with the kind of order book that they are getting from abroad. So all these three things are making L&T look very interesting to us, especially for a mega cap, especially for a large cap stock like L&T. Then there are some exposure that we have into the railway space, and this is a PSU company. I can talk about it, Ircon. So they are in a situation wherein they are picking and choosing what kind of projects they want to take. And right now they're focusing more on just the execution. So their plates are full, and of course, at some point in time, they'll again push on the pedal for more projects. So then, as I said, defense is one sector that we like. In again, PSU defense companies. Then in the small cap space, there's a stock called Power Mech. So they are doing very well, and this is in the more unglamorous side of power chain. So basically, more related to thermal power plants, coal-based power plants, and of course now they're expanding into other parts of infrastructure activities also. So these are all companies which have managed to get very strong order books, and now which are expanding their ability to execute on these. So there is a very high visibility on the revenue as well as margins from here. So that's why, and to us, it's not just about the next 2 or 3 years, because another big round of power ordering is going to happen, not just from the government side, from the private sector side also, for all these companies that we talked about. So that's why they are looking very good from next 4 or 5 years perspective.
Vipul, I want to understand, before I let you go, I want to understand what is the earnings growth your portfolio is forecasting 12 months far out, and versus that, what is the average valuation of your blended portfolio?
So see, we have a high, as you rightly said in the beginning, that we have a fair mix of small cap, mid cap, and large caps. So our earnings growth forecast for fiscal 25 is almost 45%. And the average weighted average P multiple is about 27 times. So we are higher than the Nifty P multiple for obvious reasons, but at the same time, we are much higher than Nifty 50 earnings growth. And we are very happy with that. So it's a fair mix, very well diversified stock that we have, almost about 25 odd stocks. we keep at one point in time. Between 20 and 25, right now it's 25. And as I said, sectors like bank, they don't give you that kind of 30, 40% growth, especially the large banks, but they're late teens, early 20s. And then there are some stocks that we talked about, especially in engineering and infra sectors, wherein you can get as high as 50, 60% kind of earnings growth.
All right, Vipul, we'll let you go on that one. Thanks so much for joining us on the show today.